Cool, so my name's Tien, also known as Take Note. In this video, I'm going to be swiping a chart clean and analysing the US30 chart, so we're all up to date on what's going on in the US30 chart. I'll also be explaining to you guys what I think is going to happen in the next week, in the upcoming week. But so you have a fresh understanding, let me do a quick analysis of what's going on. So as you know, we've been trading, or if you don't know, we've been trading a trading range on US30, and this range looks like this over the past couple of months. And what's been going on is price has just been bouncing from a premium to a discount, and within this premium and discount array, we also have fair value gaps, which help to guide us in regards to our entries. So what this means is institutions like to position within the premium and discount array, but they also like to ensure that they're positioned correctly by buying in a discount, and the discount is simply at the lower half of the range, and selling in a premium, which is simply the higher part of the range. The first trade that we had this year was the sweep of liquidity right at this level. When we swept liquidity here, price was at a discount. Institutions decided to position at the discount to target the highs. That was the first trade for the year. Followed by that, we had a market structure shift at a premium level right here. And as soon as we had a premium shift, market structure shift, price ended up targeting the lows. The area that price ended up pulling back to was a discount level on the outskirts of the range, which is right here. Why is this important? Well, some people might look at this and think this has nothing to do with the fair value, with the range, I should say. It's out of the range, or markets most like to have broken the range and probably try and break and retest. And what's that going to look like? Something like this, I assume. But the issue is, this setup is valid only because price failed right here to retest and re-enter the range. So when price bounced off here, we was expecting a massive rally back into the range, and we failed to get back into the range yesterday, which is quite unfortunate. So based on that, we can now expect price to, retest the range and then continue lower to target lower levels of liquidity. Now, where do we have lower levels of liquidity? We have quite a few levels of liquidity. The most obvious one is this one right here. This is a level of liquidity, and I'll just mark that out. We also have a fair value gap right at the low, which is a minor fair value gap. And after that, we have liquidity building up right here. How do I know that this is a level of liquidity? In case you didn't watch my last video, when we have a range, or should I say a trend line, we know that liquidity is always resting at the low of the trend line. Why do we know this? Because this is what you call manufactured or engineered liquidity. An example of this occurred inside this range, and this is how I knew that price would target the lows of this range on the downside. This is how I knew price failed to break these lows right here. So this level should have been targeted when we was aiming for the lows of the range, but price engineered liquidity right here. So I knew that when price came back down, we would be targeting the lows of this range. In the same way, price also failed to break the lows here of this level, which we can see right here. This level was unable to, break the lows. In the same way, this level also had a failure to breach the lows. It formed a sort of trend line. And what we know is that liquidity is always resting at the lows of the trend line. So the next level we can look at after this is probably down here. But it doesn't end there, does it? Because when we look at price down here, we can also see, if you take a deeper look, that we have some more engineered liquidity. And this looks even clearer on the higher time frame. But I'm just going to draw this out. Right here, liquidity was engineered because price failed to reach this low and breach this low and sweep liquidity. And this is seen much more clearer on the weekly chart. We failed to breach the lows. And this failure to breach the lows is what we call engineered liquidity. So in this decline, we can expect price to target all of these levels of liquidity before finally trying to retarget the highs in a massive move upwards. So it's going to be a very interesting next couple of weeks to next couple of months. Hopefully, in decline, we'll have loads of opportunities to make money, and that's the purpose of this trading channel. This channel is called Trade Shield. My name's Take Note, and this is my analysis for the next couple of weeks. That price is going to be in a steady decline in order to try and target liquidity. So it's important that you hit the subscribe button so you know how I'm positioning, when I'm positioning, and how to make money in these charts.